So credit just means purchasing something that you're not paying for right away. Okay, so if you use credit, you're a debtor. And debtor has had somewhat, people say it meaning like something negative, but debtor has no negative connotation. It just means somebody that is carrying debt, which means anybody that's financed a car, anybody that's taken out a school loan, anybody that has a mortgage, anybody that has a credit card, debtor. So there's no negative connotation to debtor. It doesn't mean anything bad. It just means that you owe money for, whatever reason. The creditors are the organizations or the people that give the credit or loan the money. So banks, credit card companies, financing companies, stores, things like that. Or people, people do personal loans. Okay. Assets are everything that you own that has value. And that's very important, that has value, because not everything you own is an asset. For example, your clothes are probably not assets because they don't retain any value. So you're looking at your house, car, your bank account balance, anything like stocks or bonds, and then expensive items in your house like electronics maintain some value, jewelry maintains value, some furniture, probably not your IKEA couch necessarily, but if you have like an antique hutch, that would be an asset. So just anything that retains value is considered to be one of your assets. Clothing, shoes, things like that, they don't, like, yes, you could probably go sell some stuff at the consignment shop, clothing wise, but it's not really an asset because it doesn't maintain its value. Your earning power is your ability to earn now and in the future. And that is based off of like your job history and your education. Okay, so if you're in college, for example, and let's say you're a senior, you're about to graduate, your earning power is going to be higher than it has been in the past, because once you have your degree, your ability to earn towards the future becomes higher. And then your credit rating is your credit report card, and this is, your credit score. And it's calculated with a mathematical algorithm that varies amongst the 3 major credit reporting agencies, which we'll talk about. But creditors, so the banks, the credit card companies, if you have utilities in your name, they don't ever count for you. They won't show up on your credit score unless you don't pay them. Then they can count against you. And we'll talk about that some more too, but basically the credit score is a report card of how well you meet your financial obligations. If you have a good high credit score, that says that you are responsible and you pay all your bills. If you have a low credit score, it shows that you may not be having a good history. Credit is a legal contract. Okay, it's obligating you to pay your debt. Okay, and now we don't have debtor's prison anymore, but there are legal options for people. If you owe them money, they can take you to court, you can have your wage garnished, and there are things that can be done. You just can't go to prison anymore. So just remember, any kind of credit card or a store credit card or a loan or anything, it's a legally binding contract. Credit reporting agencies. There are 3 major credit reporting agencies. We have Experian, TransUnion, and Equifax. Equifax is probably the largest of the three, but all three compile records on everybody that's ever had any kind of credit at all. And then the records are used to determine credit decisions. The records show all current accounts and all past accounts, generally for 7 to 10 years. However, there's a kind of a misconception that if you don't pay something, it'll fall off of your credit in 7 years. While that is a possibility, that is not necessarily the truth, and we'll talk about how that works later in the chapter. But like I said, the three major are Experian, TransUnion, and Equifax, and your score can vary from credit union or credit reporting agency to credit reporting agency, because the creditors report to the credit reporting agencies. So the creditors will report to one or two or all three. And so one creditor may only report to TransUnion, which means that Equifax and Experian wouldn't have that information. And so that can affect your credit score among the three. And then also they use slightly different calculations. So you want to check all three, but just because something's not on there doesn't necessarily mean anything's wrong, because like I said, the creditors are reporting. It's when things are on there that shouldn't be that is a problem. The FICO score is your credit score. This is your actual credit score that everybody's always talking about. It's your FICO score. And FICO is from Fair, Isaac & Company. That's the company that originally came up with the algorithm to calculate creditworthiness, which is a trade secret, apparently. You cannot find the exact formula anywhere. You can find percentages for how much of your credit score is based on your total debt, and how much is based on your debt to income ratio, and how much is based on your income and things like that. But as far as the actual math problem, it's impossible to find that. Okay. There's different kinds of credit. Of course, we have credit cards and loans, and we'll talk about those. Some of the easiest things to get for people trying to build credit is an installment plan. And an installment plan is from a store. So if you see the commercials for like furniture and pay no money down, or pay nothing until December of 2015 and low interest and all that stuff, you guys see those commercials? Easy financing. Those are installment plans. So a lot of stores will offer those. They'll let you buy the furniture or the appliance or something like that, and you have so long to pay it off. And they set up a payment arrangement with you. That's the installment plan. And it's for a set thing. Like, so I'm buying this $2,000 set of furniture. It's for that $2,000. I can't go back to the store and like add to it as I pay it down. It's just the one set thing. I could go to the store and maybe do a different loan, but it wouldn't. It's not like a credit card. You do pay a down payment, which will either be a set amount or a percent of the total purchase, and that's kind of your good faith payment. Like, yes, I'm going to pay on this because here's some money now. And then you are charged interest, and interest is the finance charge or interest. The names are interchangeable. And that's the fee that gets charged for use of the credit. So it's a percentage of the total purchase price. And it can be calculated in the same way as bank interest. It can be simple or compound. Compound is the most common, because just like when you have compound interest on your bank account, so you earn more interest, the companies want to charge you compound interest because they get more money. Let's look at Heather. wants to purchase an electric guitar, and the price of the guitar with tax is $22.40, and if she can save $90 a month, how long would it take her to save up to buy the guitar? So we're going to take that $22.40 that the guitar costs, and we're going to divide that by 90, and that's going to be 24.9. So we're going to say it's going to take her 25 months to save up for her guitar. Okay. But Heather's impatient, and she doesn't want to wait 2 years to buy this guitar, right? How does she even know it'll still be there in 2 years? So she talks to the person at the music store that if she buys it on an installment plan, she can put down a 15% down payment. Then she can pay $88.75 a month for 2 years. So how much is this going to cost her? Okay. So first we're going to figure out what's her down payment. Her down payment is 15%. So 15% becomes 0.15. So she's going to pay $336 down on the guitar. And then she's going to pay 2 years for $88.75 a month. So 2 years is 24 months. So that's 24 payments of $88.75. So in payments, she's going to pay $2,034. Okay. So, whoops, I wrote down the wrong. Ignore my 2034. I wrote down the wrong line. I was looking at the wrong problem. It's 2130. Okay, so she pays $21.30 in payments, and she paid a $336 down payment. So that means she's going to pay $24.66 for the guitar total. Anytime you finance something, you will always be paying more than the actual price, every single time. So, okay, that's not, I lied to you, that's not 100% true. If you get 0% interest, then you're not paying more. But with 0% interest on an installment plan, it's usually 0% or pay no interest for the first 6 months. So you'd have to pay it off in that 6 months to not pay interest. Does that make sense? Okay, so the guitar was originally $22.40, but she's paying $24.66. So her finance charge is $226. Okay, and this is where the decision comes. If you know how to figure this out, you know how to figure out how much the interest is. That's when you can make that decision. Okay, do I want to just save the $90 a month and buy the guitar outright and pay $22.40 for it? Or do I want to have the guitar today and pay an extra $226? And that's a personal decision. That's a decision you have to make. Is this thing that I'm thinking about financing worth however much this extra money is? Things that I can tell you for sure not to buy on credit cards or finance, anything that's consumable, that's going to go away. So like food, don't take your credit card and go buy Burger King. You don't want to pay interest on a Whopper, right? I mean, that's not, the Whopper's not worth the money you're paying for it to begin with. It's certainly not worth paying extra for, right? So anything that you're not going to still have later, you don't want to pay financing charges on. Anything like this, like a guitar or furniture or something that's like keepable, solid, like a possession now, that would be when you can consider, okay, is it worth what extra I'm going to pay for it? plan, and this is like what I was telling you, they will put out these ads for flooring, appliances, roofing, furniture, things like that. No interest for 6 months if you buy this weekend for, our special sale. So what'll happen is, there should be an E on that there. There's no interest as long as you pay in full within that amount of time. If you don't pay in full within that amount of time, then you get charged all that back interest. So that 6 months you got interest free, you do end up having to pay that interest if you don't pay the thing off in 6 months. And then they'll do these low monthly payments, $20 minimum monthly payment. Okay? But if you look, they're buying $2,000 worth of carpeting. At $20 a month, is $2,000 going to be paid off in 6 months? No. And so then you end up paying the interest charges. So it's kind of a gimmick, and people fall for it and then end up paying the interest anyway. So here's what happens. If you pay the minimum payment for 5 months, so for the first 5 months you only pay $20 a month, you'll have paid $100 towards your carpet. Okay, and then on that 6th month, if you want to avoid interest, you take your $2,134 carpet, you paid $100 of it, that would mean you'd have to come up with $2,034 if you wanted to avoid the interest charges. And what will happen is somebody will go in to, say, like one of these sales, right? And here's what should happen. You can take advantage of that 6 months interest free. You make $2,134 purchase, and you're going to want to pay it off in 6 months, and so you need to divide $2,134 by 6. And you're wanting to pay $355.67 a month. And if you pay the $355.67 or $356, and then the last month it'll be a little bit less. If you pay that every month, on the 6th month it'll be the same payment, and then you've avoided interest charges, and you've gotten the carpet for 6 months, and you got to make payments with no finance charge. The store is counting on you not doing this because you only have to pay $20 a month. You should pay $355. But because you only have to pay $20, a lot of people will keep their other $330 and spend it on something else and only pay $20. And then they don't pay it off in the 6 months, and then they owe the interest. And that's what the store is counting on people doing, is not thinking it through 100% and not sticking to this, split it up over the 6 months and not have to pay any interest kind of thing. A good credit score is any score that is 700 and over. Okay, so you want at least a credit score of 700. An excellent credit score is any score that is over 770 or over 800. It depends on who you ask, like which credit reporting agency. But 770 to 800, somewhere in there, it becomes excellent. Risky or poor is below 600. And anything between 600 to 700, I would say iffy. It's not good, but it's not poor either. It's sort of, I would say that's more of a risky area. If you're between 600 and 700, you can get financed, not by everybody, but you're going to have really high interest rates. Okay. Up here, you're going to have fantastic interest rates. And no problem getting financed at all. And in between 700 and 770, you're going to have average interest rates or good ones. And most likely you get financed for things. Okay, now your credit score is not the only thing that comes into play when they're making decisions on whether or not you can get financing. Your income comes into play and your debt to income ratio come into play. And we'll talk about those a little bit more later. Below 600, it's very difficult to get financed for anything, and you're going to pay horrendous, horrendous interest rates if you do. You're looking at 20% and more for things, and that's bad. All right, let's look at this example. Mike has a credit rating of 720, which would be considered good, and Tyler has a credit rating of 560, which would be bad. They apply for identical loans, and Mike gets a 5.2% loan. That really shouldn't be 3% higher. It would, in reality, the difference between a 720 and a 560, you're looking at probably a 10% difference in interest rate, but we'll just stick with the problem, which is 3%. So Tyler's interest rate is going to be 8.2. Okay. So we're going to look at, that's the question, what interest rate is Tyler charged? So Mike is 5.2, Tyler is 3% more, so 8.2%. If they each take out a $3,000 loan, okay, now we're going to assume simple interest on this because we weren't told otherwise. We're going to find out how much interest will each of them pay. Mike is going to pay 5.2% interest, so that's 0.052 times 3 years. And Tyler is going to get charged the 8.2%, so that's 0.082 times 3 years. So Mike is going to pay $468 in interest on his $3,000 loan. Tyler is going to pay $738 worth of interest on his loan. Now, realistically, if your credit score is 560, you're not going to get a loan from a bank, period. They won't touch anybody below 620 for the most part. And if you do get a loan and you're talking about a difference between a 720 and a 560, you're looking at a lot more than a 3% difference. It's probably more like a 10% difference on the interest rates. A promissory note is an agreement that you sign whenever you take out a loan. Okay, so you don't sign a promissory note for like a credit card, but for a loan you sign a promissory note. And a promissory note is your promise to pay back the money. And it is legally binding, and it states all of the conditions of the loan. So it states the amount of money that is being borrowed, it states the interest rate, it states the payment amount, the monthly payment, the total number of payments, the total amount that will be paid by the end of the loan, the finance charge. It has to have all of that information in it. It talks about if there are prepayment penalties or privileges, which we'll talk about what those are, just everything. And if you go to the bottom, the Truth in Lending Act down here is a law that was passed that says that the promissory note has to contain all of the required information or it is invalid. So if it's not on the promissory note, it can't happen. So like if they never put in there that you're not allowed to pay the loan off early without a penalty, then they can't charge you a penalty if you pay it off early. You know, things like that. If there's nothing in the promissory note about a late fee, if you make the monthly payment late, then they can't charge you a late fee. It has to be in the promissory note to happen. And so the promissory notes are long, but they have every single detail of the loan, and you want to read them carefully because they are legally binding, and you don't want to sign one without knowing exactly what you're signing yourself into. Now, that might take a long time to read, and loan officers and things will just hand this to you and be like, highlight, or, you know, they'll have these places highlight. They'll be initial here, 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 and sign there. And they want you to just do it. Don't read it. Make sure you read it, okay? The principal, we talked about principal. We talked about that with banks, and principal is the amount of money you're depositing. But in this case, principal is the amount of money that you're borrowing. And then your annual percentage rate is the interest paid per year on the balance owed. It's a percentage. A cosigner. If you have poor credit, you may need one in order to get a loan or take out, you know, to like finance a car or something. But cosigning is a very big deal. If someone cosigns for you, or if you cosign for somebody else, what you're saying is, or what they're saying is if the person that's taking out the loan doesn't pay, I will. So it's a big deal for somebody to cosign for somebody else. And I don't think some people realize that, like, hey, cosign, sure, why not? They don't really think about like what that means. But if you're cosigning on a loan, you are promising to pay if the other person doesn't. So like if somebody is taking out a car loan and they don't make the payments, then you have to make the payments. That doesn't mean you own the car. It just means you have to pay for it. So, you know, just co-signing, big deal. It's not some casual thing. It means a lot. And it's, if you ask somebody to co-sign for you and they agree to do so, they are doing you a really big thing. And vice versa. If you co-sign for somebody else, you're doing a really big thing for them. Life insurance is sometimes required to cover a loan in case of the borrower passes away. Usually that's more on like mortgages and things than like small loans like car loans. So, but they may require it. And then we already talked about the Truth in Lending Act. Okay, your prepayment privilege versus a prepayment penalty. And this will be in the promissory note between these two, whether you have a privilege or a penalty. The prepayment privilege means that you're allowed to pay your loan off early. And paying your loan off early means that however many months early you pay off the loan, that's that many months of interest you don't have to pay. And so it reduces your total interest charges. And depending on how early you pay off your loan, you can reduce your total interest by a lot. And so some loans you're allowed to pay off early with no penalties. Some loans, there may be a prepayment penalty, which means that if you pay off the loan early, you're going to be paying a fee. Now, it may still be worth it because if the fee is less than the interest you would have paid by not paying the loan off early, then of course you still save money. But like I said, this will be in the promissory note, so you just want to find out before you go paying off your loan early if there's a penalty or not, and if there is, how much it is. And that way you can make an informed decision. That's all. If the fee ends up being more than you'd save on the interest, then you just pay the normal payments because you don't want to lose money on the deal. Okay, and then we have a wage assessment versus a wage garnishment. Now they're similar in that both of them result in money coming out of your paycheck. The difference is a wage assessment is voluntary. whereas a wage garnishment is involuntary. With a wage assessment, this is a voluntary deduction from your paycheck used to pay off debt. Your creditor and your employer must agree to this. But you could decide, let's say you have direct deposit of your paycheck to your bank. And that's the same bank you have a car loan from. Well, you could talk to the bank and your job and have them split the direct deposit, and so some of the direct deposit goes into your bank account and the other bank part of it goes and pays on your car payment. And then you don't even have to worry about your car payment, it's just automatic. You know, so that's a wage assessment. That's a decision that you made just to make things easier for yourself. The wage garnishment is because something is wrong. Wage garnishments occur via a court order, and so this means you've been sued. Okay. Most of the time, wage garnishments occur over government money, IRS, child support, things like that. That's the majority of wage garnishments. But if you owe somebody money, like you have a huge credit card balances or something and you get sued for that, then that can also result in a wage garnishment. And so what happens is the money gets taken out to pay off your debt, but you didn't choose it, it was court ordered. So this is not a good thing. This is a good thing, this is not a good thing. And then we have something called balloon payments. Some loans even out equally. It's where like every single payment is the exact same amount down to the last penny. Some loans, your last payment can be higher than your previous payments because of just the way things work out. And maybe your last payment is a payment and a half or 2 months worth of payments. And then in some types of loans, your last payment, that balloon payment, can be huge. Like thousands and thousands and thousands of dollars huge. And this also has to be in the promissory note. If there's a balloon payment. And we'll talk about kind of how that can happen in a minute. A lending institution is any organization that extends loans. There are many, many types of lending institutions. And they make a profit by charging interest. Banks are the most common loan provider. We have savings banks and commercial banks. They both have good interest rates, but you need good credit to borrow money from a bank. Commercial banks, because they're used by businesses, have a lot of money to lend out. So sometimes their interest rates are a bit better than a savings bank. Credit unions are like a bank, but members own a credit union, as opposed to it being a corporation. So the members own the credit union. Only the members can borrow money from a credit union. And so there's, different membership requirements to even become part of the credit union. But credit unions have lower interest rates than banks for loans. So if you can be a member of a credit union and get a loan from a credit union, you're going to get a better interest rate, which means it's going to cost you less. Then you have consumer finance companies. These are not banks, but they're finance companies, and they lend money to people with poor credit, and they have high interest rates. You know those cash advances you can get on your paycheck? You see here, hear the commercials for those and stuff. Do you know what the interest rate on a cash advance is? 500%. It's a short-term loan, so the fee is not that much. It's like $35 or $50, depending on how much you borrow or whatever. It's a small fee, and you think it's not that much, but it's actually the annual percentage rate on that, because it's only for like a 2-week period or whatever, is 500% at most of those places. Some of them might be as low as 300%. But it's ridiculously high interest on a cash advance loan. And then the other kind of, you can get like actual loans from consumer finance companies for a couple years, but they're going to be really high interest rates. You're looking at in the 20 and 30% range. And in that car example I told you about earlier, if you borrow buy a $30,000 car with bad credit, or not bad, but maybe like questionable credit, you're looking at a 12% interest rate costing you like $13,000, $11,000, $13,000. A consumer finance company is going to be even higher than that. You're looking at 20% interest rate, so really, really high interest. You can also borrow money from life insurance companies if you own a whole life policy. So really quickly, there's two types of life insurance that you can buy. You can buy term life and whole life. Okay, term life insurance is cheaper, but term life insurance doesn't accumulate any value. So like, let's say I buy a $100,000 term life policy and it costs me $20 a month. I pay $20 a month, and then when I die, my family gets $100,000. However, if I stop paying $20 a month, the policy just goes away. It didn't accumulate any value. I don't get any money back. With whole life, you're buying into a policy that actually accumulates value. So it's not going to cost $20 a month. It's going to cost like $50 a month or something. But you pay years and years and years and years. And when you get older, you can actually cash it out and get the money for the life insurance policy while you're still alive and use it for part of your retirement. Or if something comes up later on down the road and you have a whole life insurance policy, you can actually take out a loan against it. And you pay really low interest because you're borrowing your own money from the life insurance company. So whole life, if you can make the payments and you can get a whole life insurance policy, which while you guys are still really young, the whole life insurance payments are really cheap. It's when you get older that they get more and more expensive. But if you get a whole life insurance policy in your 20s, you're looking at $20 or $30 a month. And so by the time you are ready to retire, you'll have like several $100,000 maybe built into that. So it's something to look into. And again, if something comes up later, you can borrow money against it, and you pay incredibly low interest because you're borrowing your own money.
So basically, what your life insurance is if you die.
Shops. You can take out a loan from a pawn shop. You can get a small, quick loan. And it is based on the value of your collateral. That's the thing that you're pawning. And you usually get 30 to 90 days. And you usually get 20 to 35% of the item value. The collateral is the personal item that you put up in exchange for the loan. Now, if you're talking about a mortgage or a car loan, your collateral is the house or the car that you're mortgaging or getting the loan for. Because if you don't pay, they take it back, the house or the car. If you're talking about a pawn shop, your collateral is the jewelry or the camera or the musical instrument or whatever it is that you've pawned to get money. You only get 20 to 35% of the item value, and your interest rates are really high. I don't know the percentages on those. To be honest, I have never tried to pawn anything, so I don't really know what the percentage is, but I know that the interest is really high and that they only give you 20 to 35% of the value. If you do not make your deadline to pay to come get your item back, then they sell it. So it'll be in the contract, the pawn contract, it'll be 30, 60, or 90 days. And at that 30, 60, or 90 day mark, if you haven't paid it, then they can sell it. Now, okay, we have a monthly payment formula. This determines the monthly payment of a loan. Okay. M is the monthly payment. P is the amount of the loan. R is your interest rate as a decimal. 12 is how many months there are in a year. And T is the number of years for the loan. And this calculation allows them to compute, this is how the banks and everybody computes the monthly payment for the loan. This is a table of monthly payment per thousand. Now they also have tables, but it's per thousand. So if you have nice even thousands and you're on one of these 1 year, 2 year, 3 year, 4 year, 5 year, or 10 year loans, you can use the table. And that makes the calculations really easy. But if you have, instead of taking out like a $5,000 loan, you're taking out a $5,362 loan, this table won't work. Okay? But the interest rates are on this column, and then the years, the length of the loan, and this is the amount of money per 1,000. So you take this amount and you multiply it by the number of thousands that you're taking out. So if you were borrowing 5,000, you'd multiply it by 5. If you were borrowing 10,000, you'd multiply it by 10. If you look, what is the monthly payment for a $4,000 2-year loan with 8.5% interest? Well, it's already highlighted on your thing. We come across 8.5% interest. We come down 2 years loan, and that brings us to this box right here, which has 45.46 in it. 45.46. That's 45.46 per 1,000. Okay. So we have 4 1,000s because we've got $4,000. So far good? So I'm going to take 45.46 and I'm going to multiply it by 4. And that makes that monthly payment $181.84. So that's how you use that table. If it had been like a 5-year loan, we would have come down this 5-year column and multiplied 2052 times 4. Or if it had been at a 7%, we'd have come across here and multiplied 44.77. Now, what is the total amount of monthly payments for a $4,000 2-year loan? Well, first we figure out a 2-year loan is 24 months. The monthly payment is $181.84, and we're going to make 24 of them. So the total is going to be $4,364.16 is the total paid. And if you wanted to find out your finance charge, that's on the next page. Never mind, we're not going to do that right here. Find our finance charge. We take our total paid, which is $4,364.16, and we subtract the original amount of the loan, which is $364.16. So that's our total interest paid. And this is our last example for this section. So here we look at this loan amount, and it is $28,716. So it's not an even thousands, so we can't use the table. So if it's even thousands, you can always use the table. Well, even thousands with a percentage that's on the table. You have to have both. Even thousands, I guess you have to have 3 things. You have to have even thousands. You have to have one of these percentage rates that are on this table, and it has to be one of these terms, 1, 2, 3, 4, 5, or 10 years. If we look at this, we've got not even thousands, 4-year, and 5.12. So 5.12 is also not on our table. So we're going to have to use that monthly payment formula, which we will write down again. And you might notice that it kind of looks a lot like the formulas from last chapter. It's based on the same math. So we're borrowing $28,716, 5.12% interest, which we had to turn into a decimal, and we're doing 4 years. Oops, there's a T right here. Sorry, I left that off. Okay. I'm going to show you guys to do first. Do these, which is all the same, and these first. So I would have 28,716.004267. 1 plus that, so 1.004267 to the 48. And then 1.004267 to the 48 minus 1. Then the next thing you need to do is the exponent. Okay, so 28716.004267, and then when I do that to the exponent, I get 1.226764559. Okay, then I'm going to multiply everything across the top, and I'm going to subtract on the bottom. So that gives me 150.31 divided by 0.226745559, which gives me a monthly payment of $662.97. Because I divided these.